How much money can you earn from dividends when you invest in the S&P 500? The thought of earning dividends just for investing your money and receiving a little bit of cash flow as you wait for your capital to grow can be exciting. But how much does the S&P 500 pay in dividends, and how much money would you need to retire on dividends solely from the S&P 500? We'll take a look at the current dividend yield from the index, as well as take a look at some real-life scenarios. Stick around because this is pretty surprising. The dividend yield of any stock or fund changes all the time, because stock prices are always moving up and down. Since dividend yield is based on the annual dividend payment divided by the stock price, if prices go up, the dividend yield goes down, and if prices drop, the yield goes up, assuming the dividend itself stays the same. On top of that, companies regularly adjust their payouts, often increasing them, which also causes the yield to fluctuate. Some companies are known for raising their dividends every year, while others might cut or suspend them during tough times. Because of this, dividend yields aren't fixed. They shift based on the market and corporate choices. Right now, the S&P 500's dividend yield is around 1.25%. So let's use that as an example to see how much someone could earn in dividends at different investment levels. If you have $10,000 invested in an S&P 500 index fund or ETF, a 1.25% dividend yield would give you about $125 per year in dividends. That's not a huge amount, but it's completely passive income. You don't have to do anything to earn it. And if you reinvest those dividends, they'll buy more shares, which will then generate even more dividends in the future. If you invest $100,000, your annual dividend payout would jump to about $1,250. That's still not life-changing money, but it could cover a small bill or two. More importantly, if those dividends are reinvested, they'll help your investment grow faster over time. Now, if you're working with a $1 million investment in an S&P 500 index fund, you'd be looking at around $12,500 per year in dividends. That's a much more meaningful amount and could easily supplement other income sources. Now, if you've got $5 million invested in an S&P 500 fund, that 1.25% dividend yield would bring in about $62,500 per year. At that point, you're looking at some serious passive income, and you should be if you've managed to save that much money. It might even be enough to cover most, if not all, of your living expenses, depending on your lifestyle. Keep in mind that these dividends are just part of the equation. Your investment isn't just sitting still while you collect payouts. The S&P 500 has historically averaged about a 10% total annual return before inflation, which includes both dividends and stock price appreciation. That means while you're receiving passive income from dividends, the overall value of your investments is also growing over time. For example, if you have $10,000 invested in the S&P 500, your overall return, which includes both dividends and stock price growth, would be about $1,000 per year. This is assuming the market continues to perform at its historical average return of around 10% annually. While $1,000 might not seem like a life-changing amount on a $10,000 investment, it's a solid start. Plus, as your investment grows, the amount of money you make will grow exponentially thanks to the nature of compounding. If you increase your investment to $100,000, the total return would grow to about $10,000 per year. At this point, the return starts to become more significant, and the growth of a portfolio this size becomes much more noticeable. Again, this total return includes both the dividends you earn, roughly $1,250 annually, and the appreciation and stock value. The longer you keep your money invested, the more this return will continue to grow, and if you reinvest those dividends, your portfolio will compound even faster. With $1 million invested, you'd be earning a total return of about $100,000 per year, again factoring in both dividends and stock growth. At this level, $100,000 a year surpasses the living expenses of many people. With this kind of return, you can think of your investment as a real source of wealth building. If you continue to reinvest dividends, you'll see your portfolio grow faster, compounding your gains year after year. Now, with $5 million invested, you'd be earning roughly $500,000 per year. Even though the dividend yield itself would only account for a fraction of that, about $62,000, the rest comes from appreciation of your portfolio. $500,000 per year in total return could comfortably replace a full-time salary, fund a lavish lifestyle, or be used for reinvestment, allowing your wealth to grow even further. These totals represent the annual dividends, but since most companies and funds pay out quarterly, you'd typically receive about a quarter of that amount every 3 months. The important thing to remember with all of these figures is that the total return doesn't come from dividends. While dividends provide a nice, steady stream of income, the vast majority of your return comes from the long-term growth and the value of your investments. As the stock market increases in value over time, so does your portfolio, and with that growth comes a higher overall return. This is what makes investing in the S&P 500 so effective. It provides strong growth that leads to impressive compounding and long-term capital appreciation. Some people want to boost their cash flow from investments, and a high dividend ETF is a great way to do that. Dividend ETFs focus on stocks that pay higher than average dividends, giving you more income from your investments. There are even S&P 500 ETFs that target only high dividend paying stocks within the S&P 500, but one of the most popular high dividend ETFs is Schwab's SCHD. This fund offers a much higher dividend yield of about 3.5% compared to the typical 1.25% yield you get from a regular S&P 500 ETF. Rather than holding primarily tech stocks, it holds big companies in different industries, such as Chevron, Coca-Cola, and AbbVie. With $10,000 invested in SCHD, you get about $350 in dividends per year. That's a lot more than the $125 you get from a standard S&P 500 ETF. If you invest $100,000 in SCHD, you'd receive $3,500 annually in dividends. Now, with $1 million invested in SCHD, you'd be looking at $35,000 per year in dividends. That's enough to cover a good amount of living expenses or even provide a comfortable income combined with the Social Security benefits. It makes a huge difference when you have a higher dividend yield working for you. Finally, if you have $5 million invested in SCHD, your dividends would total about $175,000 per year. That's a healthy dividend income, and it could easily fund a comfortable lifestyle depending on where you live. Even though the dividends themselves are a decent portion of the return, the value of your investment would still be growing, adding even more to the growth of your wealth. SCHD and other high dividend ETFs are a great way to get more cash flow from your investments. While the total return, combining dividends and capital appreciation from SCHD is comparable to the S&P 500, it's important to remember that many dividend ETFs tend to have slightly lower overall returns despite offering higher dividends. This happens because the companies they hold are typically well established but slow growing. Their steady nature is exactly why they pay the dividends in the first place. You can check out an online drip calculator to compare the historical returns of dividend stocks and ETFs with the S&P 500 and other stocks. It'll show you exactly how the returns stack up, both with and without reinvesting dividends. The S&P 500's dividend yield changes depending on how high or how low the index is. In simple terms, when the market is up, the yield is lower, and when the market takes a hit, the yield goes up. That's because the actual dollar amount of dividends companies pay doesn't fluctuate the same way the stock prices do. Since yield is just dividends divided by the stock price, when prices climb, the yield shrinks, and when prices drop, the yield grows. When the market crashes, the dividend yield spikes. Right now, the S&P 500's dividend yield is near record lows. In the past, the dividend yield was at 3% or even higher. A big reason for this decrease is how the index has changed over time. It used to be packed with industrial companies that paid solid dividends, but now it's loaded with fast-growing tech stocks that don't focus as much on paying dividends. Instead, these companies reinvest their profits to fuel even more growth, which keeps their dividend payouts relatively low. You can see that the dividend yield has pretty much been on a downward trend for many years. Let's be honest, the dividend income from just holding the S&P 500 isn't exactly life-changing when it comes to actually using the cash. But that's not a big deal, since most people invest in it to build wealth over time, not for immediate retirement income. Still, there's something satisfying about seeing that money hit your account regularly, even if you have no plans to spend it. Just knowing you're getting paid for simply staying invested makes it feel rewarding.